Hey guys, welcome back to the channel. Today I wanted to do a fairly quick video on Vanguard's Digital Advisor. Now this is Vanguard's version of their Robo-Advisor or their automated investor. And I talked about Charles Schwab's Intelligent Portfolio, which is their version before in another video, which I'll link below. But I wanted to do a really quick review of Vanguard's Digital Advisor, the onboarding process. I've only just started with them, but I already sort of got a good sense of sort of what their product offering is. So I'll go over sort of the pros and the cons that I've seen so far. It will be a little bit focused on the onboarding process and the user interface and what I see as sort of the asset allocation that they give you. On the whole, I'm a big fan of Vanguard in general because I think they have really well managed index funds, and their process is generally very simple. They're not trying to get you to trade frequently. They're really looking for like a long-term investment strategy, which for the most part, I think everyone should be looking for. Most people should not be day trading or purchasing individual stocks. People should just be placing their money into index funds, passively managed ones with low expense ratios. So just really quickly, I want to just like give you a brief introduction to Robo-Advisors. So they're basically these automated products that you put your money in and it will do the asset allocation and ETF selection for you. So basically what it's doing is it's asking you a series of questions, just like what your goals are, what your risk tolerance is, and then based on that, it's going to decide how much it wants to put you in different ETFs. So basically how much international exposure, how much US equity exposure, how much fixed income. And generally speaking, like a risk tolerance profile will be a split between the equity markets and your bond funds, because bonds will tend to be safer. So at the beginning, it's going to ask you questions, it's going to decide your asset allocation, and then what it will do is it will rebalance for you over time. And the way Vanguard decides to rebalance isn't necessarily on a calendar basis, but on if you move outside of your targets. So basically, it will set your asset allocation targets, and if you stray from those by a certain amount, I think it's 5%, it will rebalance for you. But let's start by just sort of going through the onboarding process. So basically, it's going to, when you sign up for Vanguard, so I already had a Vanguard account, so I didn't have to go through the process of like adding my personal information. You'll have to verify your identification. You'll have to answer some questions about, your tax status, and you will have to sort of like go through a series of questions, just like administrative questions. So as far as an onboarding goes, I would say it's a fairly simple onboarding process. It walks you through sort of like in layman's terms, like what your goals are. And it's only like a handful of questions. But for the most part, it's like they're asking you like when you want to retire, how old you are. So that gets you, whenever they ask you those types of questions, or if you have goals to save for a house, what they're gauging is how long is your time horizon. Because with more time, you can withstand more volatility. So just know that generally when those questions are being asked, they're looking for time horizon, which will translate to how much risk you're willing to take. So yeah, they will ask you sort of like, what is your retirement age? And generally like, what is your risk? So they ask this question of sort of like how much variation are you willing to see? And they'll give you both down markets and up markets. So generally speaking, I always go with a very aggressive portfolio because I'm willing to withstand that, but some people aren't willing to withstand that. I think generally speaking, you probably shouldn't be checking your portfolio that often because that's just going to make you more emotional. It's going to sort of like feed into your psychological biases. So generally speaking, I will push people to go as high as they can, go to the upper level of their risk tolerance. That's just because I think that like people always underestimate how much they need their money to grow for the future. And to some extent, like if you're making money right now and you hold cash in other places, you can withstand that amount of volatility because it's really just money that you set aside. So again, all this money that you're putting into these accounts shouldn't be money that you need right away. It's really thinking like long term. They're going to ask you what your long-term risk profile is and sort of like what you're willing to withstand in the short term too. And so they do this by asking you sort of like different scenarios, within 1 year, how much loss are you willing to withstand? And then it sort of gives you just like a review of like your risk tolerance. So, and I always pick very high, and I'm not sensitive to downturns because I think those are opportunities. And then finally, it sort of aggregates your risk assessment, and I ended up being very aggressive, which is where I want to be, because I think I prioritize growth over consistent sort of income. And then they sort of give you like your initial projections of like what you can expect over time. You might see some volatility, but where you're going to sort of like see your assets grow over the next, 30 years. Of course, like depending on your age, you might not have 30 years, so you might not want to do that. It then offers you sort of a chance to create your sort of like retirement plan. So you can customize that if that's something that you want to do. But on the whole, like if you want to just get through this quickly, you really just need to answer the risk tolerance questions. And again, like go with what you're comfortable with, but I would always push you to do a little more aggressive. Now, one thing to note is that there is a small fee related to Vanguard's Digital Advisor, like there is with many other Robo-Advisors. And they kind of give you an estimate of how much you're going to pay. And so it's a pretty low fee. I think it's quoted at 0.15%, which is smaller than generally it's a 0.25%. 25 basis points is the amount that you get charged for automated investors. So it's lower, let's say. They also waive the fee right now for 90 days, I think. So you can try it out without much risk. Let's talk about the asset allocation that they put me in. So with a very aggressive portfolio, basically they split my money 60% the Vanguard Total Stock Market ETF, VTI, which is a US equity market passively managed fund, and then VXUS, which is their international stock fund. That's also passively managed. So this is a very simple strategy that you can use to just get a diversified portfolio. It doesn't hold cash. It doesn't hold bonds. It's all stock, which is like what you want to do if you want an aggressive portfolio. If you had selected a less aggressive portfolio, it would have put you in bonds too. I'll get to some of the other ways that they gauge like how they should be asset allocating for you. But really like what ends up happening is they put together a very simple portfolio with 2 ETFs, which you honestly could recreate yourself and save yourself the 0.15% fees, because it is very simple to get going. So yeah, talking about the interface, one thing I have always sort of like said about Vanguard to my friends is that their UI, their user interface, is not amazing. It's really not as sophisticated as a lot of the other apps. It's not as intuitive as many other apps. It does present you with like important information that you need to know, like your performance, your asset allocation. But I will say that on the whole, it's less sophisticated than most of the other brokerage accounts. To what I have heard though, and what I sort of agree with, is that Vanguard's UI makes it more difficult to trade, which is actually good for most investors because, a lot of the other brokerage accounts, they want to incentivize you to trade more often. And for the most part, you should not be trading often. A normal everyday investor should really just be placing money into a couple ETFs and leaving it there for a long time. It has a few different places that you can go. So you can basically like look at your asset allocation and you can see the holdings that you have. And so for this example, I put in $1,000. You can check out your asset allocation mix. You can check out your performance over time. It's a fairly simple sort of overview of your portfolio. There's another section that's basically your activity feed, which is like basically transactions. I haven't been with the Digital Advisor for long enough to see it rebalance, but according to Vanguard, the Digital Advisor will rebalance the portfolio if it's shifted from its targets by more than 5% in any asset class. So it isn't a time-based rebalance, it's just a target-based rebalance. On the whole, the onboarding process is fairly simple with Vanguard. It invests in Vanguard ETFs, which are very low cost ETFs, and they're managed in, a very efficient way. On the whole, I always recommend Vanguard's ETF. So the benefit of being in a Vanguard Digital Advisor is that they're going to automatically invest you in Vanguard funds, which I think are preferable to other funds. Again, when I was talking about Charles Schwab's Intelligent Portfolio, it invested in only Charles Schwab ETFs when they were available, and those tended to come with higher fees. One other benefit that I haven't obviously experienced yet, but that Vanguard talks about is that it does tax loss harvesting. So the Robo-Advisors tend to consider taxes when selling and buying securities. And so you want to optimize for your tax bill, and that's not always something that you're going to be able to do easily if you're self-managing. I will say the more you just don't sell anything, the less you'll have to worry about with taxes. But every once in a while, you may want to sell at a loss in order to lower your tax bill. And that's something that the Robo-Advisors can sort of do for you. It will be less sort of strategic and more just general, but at a minimum, it's going to try to optimize for tax loss harvesting. You don't need a lot of money to start. I think you only need $100 to start your account. You can create recurring transactions as well. I'm very much a proponent of automating your investments. The way I evaluate robo-advisors is I look at a few different things. I look at how they asset allocate. I look at how they rebalance. I look at the fees that they charge. I look at the securities that they purchase for you. And generally, I look at the ease with which you onboard and maintain your portfolio. Vanguard is a good product for that, for all of these reasons. It's fairly simple. It's low cost. The asset allocation is also simple but effective. And it invests in very low cost, passively managed funds that I like. I did come across one thing that I found was a small quirk for me that I didn't expect, that sort of I wanted to raise a red flag really quickly. So they have this financial planning tool where you can add different goals. And generally when I see these in a lot of these products, they're just to be able to plan for yourself, to make a budget or to add a goal that you want to achieve. But what I didn't realize was that when I added a goal just for fun to try it out, it actually switched my asset allocation. So one thing to note is that once you set your asset allocation, if you don't want it to change, don't add a goal with your money here, because it will shift. So if you end up changing the goal to being something shorter term. So what ended up happening in my case was I created this fictitious goal that had a short-term goal to it, so within the next couple of years. And what it ended up doing was selling all of my equities and placing it all inside basically a bond fund and in a money market, which I didn't want it to be. It's pretty much a set it and forget it tool. So far of the Charles Schwab Intelligent Portfolio and the Digital Advisor, I will say that with Schwab, you actually don't have as many choices as you do with the Digital Advisor, which in some ways is better because the less you can play around with it, the less room there is for error. But I will say Vanguard is generally what I recommend. And their asset allocation is actually fairly simple. I would say for someone who really doesn't want to look at their portfolio, Vanguard is the way to go. And I like that they don't hold cash, because you have cash elsewhere and it's not really effective for your investment portfolio to have cash also. So I would recommend, my recommendation when using Vanguard's Digital Advisor is to just set it up with an aggressive portfolio and to just leave it. If you can, I would do recurring contributions to keep purchasing into it. But it's really going to be fairly simple and effective in maintaining your long-term goals. If you're fine rebalancing every once in a while yourself and you want to save yourself the 15 basis points, the 0.15% annual service fee, you can pretty much achieve this by buying 2 ETFs, the ones that they gave me basically. One US equity market ETF and one international market ETF. And honestly, depending on what you believe, as far as how you think the US economy is going to do, you can modulate that as much as you want. You could do 80% US equity, 20% international. You could do 20% US equity, 80% international. So it's really like kind of a question of whether you want to sort of do that yourself. That'll give you more flexibility also to change it over time if you want to. So in some ways, the digital advisor is great because it's so simple, but in other ways, you don't need it because it's so simple. You could save yourself the 15 basis points and just do it yourself. So at the end of the day, it might just be worth it to like sign up for a Vanguard account, a regular brokerage account, and then purchase your 2 ETFs and start some contributions to those over time. You know, the digital advisor is simple and effective, like a lot of digital advisors, and the fee structure is very minimal that it might be worth it for the rebalancing just to pay that 15 basis points. I hope you found this helpful. I will probably try a few more robo-advisors out and do some reviews on those because I think people are interested in knowing specifically which of these products is good. But again, on the whole, if you're brand new to robo-advising, you pretty much can't go wrong with Vanguard's digital advisor.